Companies are splitting, merging more than I've seen. And again, my companies are always busy, but they seem even busier than usual. And that's something that's going to come up early and often at the conference is, does that create incremental value?
Hi, everyone. Welcome to our Research at Citi podcast. I'm Rob Rowe, U.S. Regional Director of Research. And with me on the call today is Andrew Kaplowitz. He's our industrial super sector head. We're very excited to have him because we do have the Industrial Tech and Mobility Conference coming up on February 18th to the 20th, which Andrew's leading. And so it'll be great to discuss some of the themes that inevitably will be coming up and that Andrew has published on that will be coming up in the conference. Thanks for being on with us, Andrew.
Thanks, Rob. I'm really excited to be with you. We're very excited for the conference. This year is going to be our biggest and best conference yet. We have 140 companies.
Wow.
We already have over 600 clients signed up. So it's definitely going to be over 1,000 people, and we're looking forward to it.
Fantastic. I wish I was going, Andrew, but I know we'll be getting notes from you later on, and I'm sure they're going to be very informative. Why don't we move on to some of the themes that you've identified in a recent publication? No doubt that'll be addressed at the conference. I think the first one you mentioned is sort of a weak first quarter, but second half acceleration.
Yeah. So a lot of my companies actually reported good results in Q4, but guided conservatively in Q1. And I think one of the things that investors are going to try to figure out at the conference is that just conservatism, or is that still a pretty sluggish industrial economy that's expected to speed up as the year goes on? I think for what it's worth that there is some conservatism. I know we'll talk about geopolitics a little bit later. There's a lot of cross currents out there. But I think our companies, they don't really know exactly how 25 is going to unfold. There were some green shoots, which I'm sure we'll talk about in Q4, but you don't want to extrapolate too much on that. So you want to start out the year slowly.
And are there particular sectors right now, like you mentioned green shoots, but are there particular sectors that have probably maybe a better growth multiple than, say, others?
Yeah, it's a great question. So, look, we've talked a lot about electrical infrastructure, HVAC, and automation as generally our preferred sectors. I think electrical infrastructure and HVAC have continued to be strong. Obviously, data centers seems to be pushing a lot of the electrical infrastructure and power markets, I would say, are related and also very, very strong right now. HVAC is more global sustainability focus that continues even with the new administration. I'd say aerospace is also quite strong, another sector that has been very resilient and still seems resilient as you go into 2025.
Got it. And you mentioned another theme is, as you mentioned, it would be a short cycle recovery nonetheless. You're enthusiastic about the PMIs that you're seeing, which should give our U.S. economists some pause. But what do you see there?
Yeah, Rob, enthusiastic might be a little strong.
Okay.
Mildly encouraged is probably the right words for that. Um, we saw the US ISM peak over 50 in January. It's really only the second time in 2 years. New orders actually were pretty strong in the mid 50s. And it does seem like some of our companies did talk about some improvement in Q4 in short cycle markets, classic sort of consumable type end markets, maybe showing a little bit of signs of life. Automation markets, maybe showing a little bit of signs of life. And I do find that encouraging. But again, it's really green shoots is the best way to describe it. It's very early going of improvement. And literally, we've seen 1 month of US ISM over 50. Uh, I'm not going to get overly excited yet. Let's put it that
Okay.
way.
And maybe we can talk about megatrends. And I guess, and this is one of the more exciting themes for me. Which ones are coming, which ones are going, as you put it in your publication. And maybe we can focus a little bit on the continued automation of the industry and also maybe how you see AI playing out. Because I get the feeling that people are going to want to start to see, at least on balance sheet, where these innovations are starting to either improve operating leverage or improve efficiency in some way or even profitability. But Is this a short or still a medium to long term development?
This is definitely long term, Rob. I am pretty excited about the mega trends that I see. And I should say, I think they're going to continue to be resilient. I've been covering industrials for over 20 years now. Time flies when you're having fun. We haven't really seen this many mega trends since the mid 2000s. Mid 2000s was the rise of globalization, and also energy infrastructure really drove that time. Actually, the opposite is driving this time to some extent deglobalization. When you get deglobalization, it leads to the need for more duplication and what they call reshoring. And so we have seen relatively good evidence of reshoring so far through the pandemic and after the pandemic. Certain end markets, semiconductor, life sciences, maybe even energy. You've seen more moving back into the US from overseas. I think that just accelerates with the new administration. So, reshoring is still a big mega trend. I think AI, as you mentioned, may be the biggest mega trend now impacting industrials. If nothing else, it's already impacting growth. We're seeing it. Data center proliferation leads to significant growth in lots of different areas for my company, whether it's power related growth, electrical related growth, thermal management, for HVAC companies and so on. So significant growth for a lot of our companies that we think is actually still in the early innings. But what AI can also do is it can lead to increased productivity in industrial companies. You'd be surprised how a lot of our install base here in the US and factories, I think, still, let's just say, need some work. And efficiency is something that needs to be improved at these factories. They've come a long way over the last 20 years, but one of the reasons why we're still pretty bullish on margin expansion in industrials is because there still is a lot of self help needed for these companies, and it can come from AI. And that's the thing, is that I think AI proliferation is still in its very early going for factory innovation and efficiency.
Interesting. And are there so the mega trends that we have are the reshoring and AI, and I think self-help was another theme. There are other mega trends that you're thinking of?
Yeah, thanks for that question. So it's also sustainability, and it's a
Mhm,
very I would say sustainability and energy transition are mega trends that are a little bit more debatable these days, given the
mhm.
new US administration and their focus. At the same time, I think, the proverbial horse has left the barn when it comes to sustainability. Regardless of what you believe about climate change, it does seem like, weather's getting more severe. My water companies are tending to deal with like more either droughts or flooding, as an example. And so companies are sort of taking it into their own hands to improve their sustainability goals. I'd say it's also happening at the state local level here in the US. And outside of the US, places like Europe still, very important to focus on sustainability. So again, like the thing is that it's the number of mega trends that's quite interesting in industrials these days, not just one or two, but several that we've
Mhm.
just talked about.
So it sounds like with sustainability, it's a matter of consideration of damages that could take place that they need to address regardless of what the political climate is for climate change or anything else.
I think that's right. And like for instance, I think there's much more focus on something like wastewater, recycling of water. Again, like, the US West went through a major drought. I think it was 2 years ago.
Mhm,
And, that just raises awareness that you need to conserve water, as an example.
mhm.
On the HVAC side, again, like there's a global decarbonization focus that continues. It does ebb and flow, I'd say, depending on the country or the time. But in general, lots of countries and or, municipalities or localities here in the US, are demanding certain, you've heard the term net zero. That's
Mhm.
not going away.
Right,
Um,
right.
And in some places, it's still accelerating. So I'd say there's that. And actually, I should mention one other thing, which is just the overall electrification of, the world. It's slowed down here a bit. I think EV transition has slowed down a bit, in a place like the United States. At the same time, it does continue to seem like we're moving toward a more electrified world. And
Mhm.
that does lead to significant investment in CapEx that's needed, for my companies.
And in terms of going back to the theme of self-help, you mentioned one thing, but there are others, right? In terms of how you look at margin expansion, et cetera.
It's a really good question. So, again, I think digitization, we can put AI in digitization.
Sure.
Digitization is a big form of self help that my companies are still in the very early going in terms of their focus, but they are ramping up digitization as quickly as they can. And digitization generally comes with much higher margins and overall more efficiency. But at the same time, what one of my reasons why my space is called multi-industry and historically it's called industrial conglomerates is because the companies generally do a lot of M&A. But I would say actually these days it's more portfolio management
Mhm.
versus M&A. They will continue to do a lot of mergers and acquisitions. That's what they do. And if you do have a little bit more stability in the geopolitical and interest rate environment, I think you could see a lot of M&A. But besides that, you're also seeing a bit of a deconglomerization of our companies. Companies are saying to themselves, listen, we got to get more focused. And, when we get more focused, we can improve growth and we can improve margin. And so we're definitely seeing a very active period where companies are splitting, merging. There's just a lot of stuff going on in that way, more than I've seen. And again, my companies are always busy, but they seem even busier than usual. And that's something that's going to come up early and often at the conference is, does that create incremental value?
Right. And maybe we can also, Andrew, switch over to, as you call it, the rest of the world and geopolitical impact on industrials. And what I would ask first is, as we go into that, obviously a lot of the focus is on the Trump administration. A lot of the focus is on the US because there's such tectonic change taking place. And, obviously two or three areas that are big are, I would say tariffs, right? Ensuring in terms of what the Trump administration can do there, deregulation, and also I would say potentially corporate taxes. How do these things play out for industrials and industrial conglomerates? How does tariffs, are they a positive or a negative for industrials? I mean, I imagine some have a lot more trade on a foreign side and retaliation could stop that trade, as you said, deglobalization. Are these all positives or are there positives and negatives to these things?
They're all good questions, Rob.
I know it's
There-
a lot
There's
to cover.
there- there's not one specific answer, but let me say
Right.
it like this. Our companies are generally more than 50% US, or at least the companies I cover,
Mhm,
which then by their nature means that if we are more focused inwardly on the US, our companies ultimately are going to benefit. So I think that's number one. Tariffs do lead to some near-term uncertainty. It's hard if you especially if you don't have, how do I say this? Each day, there seems to be something new, along
mhm,
those lines. And so you need like more clarification and visibility about what these tariffs are actually going to be. Because if we knew the end game, then the companies would absolutely be able to plan for it. And ultimately, tariffs, lead to price increases for our company. Now, I think it's not such a bad thing to have price increases that you can get margin on for our companies, but ultimately it can lead to higher prices for consumers, as you know.
mhm,
And so I think, again, you have to be balanced about how you look at these tariffs. I think reshoring and a focus on the US ultimately is a good thing for my companies.
mhm,
But at this and tariffs will lead to that. But at the same time, tariffs also lead to near to maybe even medium term uncertainty in terms of capex decisions, how it impacts the consumer. Does it slow down, for instance, the US economy? Those are, more. not as good things that could impact our companies. I think ultimately, though, our companies tend to look at the new administration with, let's call it cautious optimism, because, it's a balancing act. Deregulation and lower taxes are generally a good thing for our companies, and that's what they want. But that is also balanced by tariffs, as we just
Mhm.
talked about. And so I think what we've argued is it's going to be a little bit of a shaking out period. It's part of the reason why, as you asked me originally, the companies are guiding relatively conservatively to start the year. Is I think it's going to take, another few months probably for us to figure out really where this administration is going and what the end game is. And once that happens and there's a little bit more certainty or stability in the overall geopolitical backdrop, the companies can plan for it and they can spend. And so our view has been that while it's encouraging that, we've seen a little bit of a PMI recovery here in the short term, we don't really expect a more consistent recovery till at least the spring or the middle of 25 because we think uncertainty will linger a little bit over the next few months.
Yeah, and then there's actually probably a positive story behind that because I imagine industrials can sort of bob and weave with whatever these changes are and be able to direct themselves more efficiently after that.
Yeah, and I'd say, Rob, like we do talk about how our companies are global, right? So yes, they're majority US, but they also have exposure to Europe and Asia. And I think we're gonna just have to see how these tariffs play out. I think our
Right.
companies have been re-emphasizing the US versus those other areas, but those other areas could continue to be a bit lethargic for our companies as the US actually potentially strengthens. So we just have to kind of watch that balancing act and see how it goes over the next 6 to 12 months.
Got it. And if you're a global industrial company, do you think that you still favor tariffs per se, or do you think that that could be more disruptive to your overall business?
Well, I'll just say it like this, Rob. If I were the CEO of one of these companies,
Mhm.
I probably would think it's a little bit disruptive.
Yeah,
Um, At the same time, again, like it's not just about tariffs if I talk to this administration,
sure.
right? They have to pay for their tax cuts. They are
Mhm.
set to expire. I think this is part of their strategy, and deregulation and smaller government is part of their strategy. And theoretically, if you put more incentives in front of the private sector, like my companies, you could generate more growth. So
Mhm.
it's definitely a balancing act that maybe we can talk to our economist about as well.
Sure, sure. And lastly, Andrew, there are regions of the world where I think you see opportunity and regions of the world where maybe it will stay a little bit more static.
Yeah, it's a great question. Again, I definitely see opportunity in the U.S. We might have a little bit of a shaking out period. Shaking out's the wrong word, but a little bit more uncertainty here over the next few months as we kind of see what the administration's exactly going to do. But I think U.S. definitely is getting a lot of emphasis these days from my companies and in general, and I think that's going to mean better capex and continued growth environment here. I'd say internationally. There are places like India and the Middle East, which, at least for my companies, are doing quite well right now and could continue to grow and become a bigger portion of of my company's sales mix. So, they might over time replace some of the more traditional high growth markets of the past. So we're watching that closely.
Fantastic. Andrew, we've come up on our time. I look forward to hearing feedback and notes from the conference on February 18th on the Industrial Tech and Mobility Conference. Really looking forward to those notes from you afterwards. Thanks so much for being on the podcast with us today. A lot of great insights here. Thank you very much.
Rob, thanks for having me.
I'll be coming back at you in a couple of weeks with our next podcast, which will feature a Nick Joseph and a discussion of the REIT markets, the REIT sector, which is going to be just before his conference in March. Thanks everybody for listening. This episode of Research at Citi was recorded on Wednesday, February 11th, 2025. I'm your host, Rob Rowe.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.